Howdy, everybody. Welcome to Liberty Call. Today is Monday, July 8th, 2024. Hope you're having a fantastical day out there in the interwebs. It's a pretty nice day here in Colorado. It's nice and chilly, and there's no hurricanes coming over, which is extra nice, which is the primary reason I no longer live on the Gulf Coast because I hate hurricanes and I hate hot weather and I hate humidity most of all. So that's what's beautiful about it up here. It was actually chilly last night. I had to close the windows in the bedroom because I didn't want to catch a cold this morning. But we're going to have some hot weather coming up next weekend. It's going to be up into the high 90s, so you can feel some sympathy for me because I don't have air conditioning. So I'll either have to go sit in my truck, or I could go out and sit in the fifth wheel. It has air conditioning, but it doesn't have a whole lot of other creature comforts sitting in the driveway, unfortunately. So, all right. Well, if it is your first time watching Liberty Call, I am glad you're here. Thank you very much. If you in the brown shirt could do me a favor, give me some thumbs up, a like, a share, subscribe, a follow, and press that notification bell. Kind of a flat day in the markets. I mean, really couldn't find any direction. So let's go ahead and hop into the indexes. Take a look there. Dow Jones finished the day down 0.08%, 31 points, closed at 39,344. The S&P 500 was up 0.06%, 3 points, closed at 5570. NASDAQ up 0.27%, 49 points, closed at 18,402. The VIX was down 0.8% today. It's at 1238 right now. Canada up 0.3%, Brazil up 0.14%, and Mexico up 1.09%. All right, let's get over to Europe. Where they are. There it is. Germany was up 0.07%. The UK down 0.13%. France down 0.63%. The Netherlands down to 10th. Spain down 0.01%. Italy up 0.17%. Switzerland up 0.43%. And Portugal down 0.34%. In Russian exchanges were both in the red today. The MOEX down 0.51%. The RTSI down 0.55%. And the overnights, the Nikkei in Japan was down 0.06%, Australia down 0.76%, New Zealand down 0.41%. In China, the Shanghai was down 0.93%, the Shenzhen Component down 1.54%, China 50 down 0.5%, DJ Shanghai down 1.08%, Hang Seng down 1.55%, and the Taiwan weighted looks like it has not been open since the 5th. All right, so those are today's markets. Exciting stuff. All right, let's move over to the weekly economic update for this week. Stocks steadily advanced over the holiday week thanks to strength in mega cap tech issues and encouraging jobs data. The S&P 500 rose 1.95%, while the NASDAQ index added 3.5%, and the Dow Jones Industrial Average ended up a modest 0.66%. Internationals or overseas stocks rose 2.3% from a week ago through Thursday's close. NASDAQ S&P extend runs. ADP's employment report on Wednesday showed private sector employers added 150,000 jobs in June, slightly slower than May's pace, adding to investor hopes that a slowing economy may prompt the Fed to adjust short-term rates as early as September. The NASDAQ and S&P 500 hit their 23rd and 33rd record closes, respectively, for the year. Friday morning's job report from the Labor Department showed 206,000 jobs added last month, which also suggested a stronger but cooling economy. News of slower job growth, slowing wage growth, and a slight uptick in unemployment helped drive down Treasury yields, and stocks finished the short week with a strong rally. The NASDAQ and the S&P both closed at all-time highs on Friday. All right, still catching up. Driving much of the job growth in last week's report was a post-pandemic catch-up effect. Sectors such as healthcare and leisure hospitality showed they are still recovering. Private sector jobs data and the Labor Department report painted a similar picture of an economy creating jobs, but at a slower rate than in the past. Economic data coming out this week. On Tuesday, we have Fed Chair Jerome Powell speaking. Wednesday, we have the Petroleum Status Report, and Fed officials Austin Goolsbee and Michelle Bowman will be speaking. Thursday, the Consumer Price Index, jobless claims, Fed officials Raphael Bostic and Alberto Musalem speak, and the Fed balance sheet. And Friday, wholesale inflation, the Producer Price Index, and consumer sentiment. Companies reporting earnings this week. Thursday, we have PepsiCo, Progressive Insurance, Delta Airlines, and Conagra Brands. Friday is JP Morgan, Wells Fargo, Citigroup, and the Bank of New York Mellon Corporation. All right, so that's everything there. Exciting stuff, I know. Let's go ahead and move over to the market recap. U.S. stocks struggle for direction ahead of Powell's testimony and the CPI data. U.S. stocks were indecisive on Monday as investors exercised caution ahead of Federal Reserve Chair Jerome Powell's upcoming testimony to Congress and key inflation data set to be released later this week. Powell is scheduled to testify before the Senate on Tuesday and the House on Wednesday, with his remarks expected to focus heavily on monetary policy. Last week, Powell indicated that while some progress had been made in reducing inflation, the Fed was not yet confident enough to start cutting interest rates. The minutes from the Fed's June meeting echoed this sentiment. Weaker than expected labor data from the previous week had raised hopes that the cooling job market might encourage the Fed to consider cutting rates. Yeah, everyone is just hoping, cut them rates. However, inflation remains a crucial factor in the Fed's decision-making process. The Consumer Price Index, due on Thursday, is forecasted to rise 0.1% month over month and 3.1% year over year, with the core CPI expected to increase by 0.2%. Traders are currently pricing in a 72% chance of a 25 basis point rate cut in September, up from 57.9% last week. In addition to rate expectations, this week marks the beginning of the second quarter earnings season. Starting with major bank earnings on Friday, investors will closely watch corporate earnings to gauge how companies are faring amid interest rates and persistent inflation. JP Morgan Chase, Wells Fargo, and Citigroup are set to report their earnings on Friday, while PepsiCo and Delta Airlines also release their figures this week. Elsewhere, Paramount Global's stock fell 5% after Skydance Media agreed to merge with the entertainment giant, ending months of speculation. Boeing stock was just above the flat after the company agreed to plead guilty to a criminal fraud conspiracy charge related to two fatal 737 MAX crashes. Corning Incorporated raised its second quarter core sales forecast to $3.6 billion from $3.4 billion and projected adjusted earnings per share at the high end or slightly above its guidance range, leading to an 11% rise in its shares to a fresh 52-week high. All right. That's everything that's going on in the markets today. Let's move on to our next article here from Zero Hedge. Disconnect between valuations and economic reality couldn't be more apparent. This was written by QTR's Fringe Finance. Let's see what they had to say. As we move into the third quarter of 2024, the market has not entirely followed the expected trends set at the beginning of the year. Despite this, the anticipated risks and dominant themes have persisted. The prediction remains that market volatility is likely, particularly around or shortly after the first rate cut, due to the effects of maintaining 5.5% rates. Several negative catalysts are yet to be fully impact the market, including potential geopolitical conflicts, an unsustainable fiscal situation in the U.S., uncertainty surrounding the 2024 election, and significant issues in regional banking and commercial real estate. Boy, those are all. I'd put my from a financial perspective, my primary worries would be the banking sector and commercial real estate, because I think they're probably going to be taking it the worst here moving forward in the short term. Consumer spending is also constrained, reflected in recent retail earnings, and the unemployment rate has risen to 4.1%, the highest since November of 21. The market has not yet priced in these risks, including the potential for another Democratic presidential term. There is a stark disconnect between the current market behavior, which seems to ignore economic realities, and the actual economic conditions where high valuations persist despite significant economic challenges. A handful of stocks, primarily NVIDIA, Apple, and Microsoft, are currently driving the market performance, creating a disparity in market breadth. The sustainability of this trend is questionable, and when it reverses, high-value stocks like Tesla and Apple may see significant sell-offs. Bitcoin's recent performance is also notable. Despite its potential as a long-term asset, Bitcoin has recently broken major support levels, indicating possible liquidity issues in the broader market. This trend suggests that Bitcoin might be the first asset sold off when investors need liquidity. The geopolitical landscape has deteriorated further with escalating threats in the Middle East and increased global tensions. The current scenario resembles the early stages of a significant global conflict more closely than it did in the beginning of the year, raising concerns about potential widespread instability. Well, that's not some good news. Let's go ahead and finish up with our third article today. How strong is the labor market? This comes from our friends over at First Trust, Mr. Brian Westbury, their chief economist. All right. Despite the solid headline numbers in Friday's job report, several underlying factors suggest that the job market may not be as strong as it appears. While non-farm payrolls increased by more than 200,000 in June, downward revisions for the previous 2 months reduced the net gain to just 95,000, with only 50,000 new private sector jobs. A significant discrepancy exists between non-farm payrolls, which are up 2.6 million over the past year, and civilian employment, which has only risen by 195,000 jobs in the same period. This gap may be partly due to a surge in immigration. Immigrants working for companies surveyed in the payroll report are counted, but the civilian employment figures, which rely on household surveys, may miss new or undocumented immigrants, illegals, who are less likely to participate in government surveys. Historical context shows that such gaps between the two surveys, while unusual, have occurred before in the mid-'80s, late '90s, 2013, and during COVID. Another concern is the consistent negative revisions to payroll reports. For instance, in 2023, revisions averaged a negative 30,000, and so far this year, they have averaged a negative 49,000. Negative revisions are often associated with impending recessions rather than robust growth. The inconsistency may also stem from a lower response rate to employer surveys post-COVID. Before the pandemic, the government had a 75% on-time response rate from employers, but this has dropped to about 65% in recent years. Companies facing difficulties might prioritize other issues over timely survey responses, potentially skewing initial data. Another unusual trend is the shift from full-time to part-time jobs. Over the past year, full-time jobs have decreased by 1.6 million, while part-time jobs have increased by 1.8 million. Such a loss of full-time positions typically signals a recession and declining payrolls rather than economic strength. These anomalies do not necessarily indicate data manipulation, but reflect the complexities and challenges in accurate capturing current economic conditions. Despite skepticism about government reports, especially following controversial policies and narratives, the labor market seems to be in a transitional phase. It stands between the robust image painted by payroll reports and the softer civilian employment data, suggesting early signs of a slowdown, but not yet a recession. All right. So that's some excellent news. The data is not great. Who knows how good it is. One of the other employment data reports, I think they said they only have about a 30% survey response rate. So 70% of the data is just made up out of whole cloth. So, believe what you might, or I guess take the data with a grain of salt is probably the best thing to do. Just looking around with your eye, you can see, depending upon where you live, retail, there's a lot of empty spaces. There's a lot of waiting around for people to help you when you go into retail, and same thing in restaurants. So, and just the general comments you get from people is just things aren't great. So, kind of just feeling like we're waiting for the next shoe to drop. Is it going to be the election? Is it going to be another super flu, or is it going to be something else? So, or a war? Who knows? All right. My best advice is be as prepared as possible for all of those events. Unfortunately, that's easier said than done. So, all right. Well, that's everything I had for today. If anyone needs anything from me, please go to DSAFinancialGroup.com. All my contact information is there. I hope everyone has a fantastical evening. And if you need help getting your financial crap together for whatever's in front of us, give me a call. Go to DSAFinancialGroup.com, and you can shoot me an email or drop me a phone call, whatever you like, and we can book some time to get your stuff back on track. Hope you have a good evening, and I'll talk to everyone next time. Adios.